And welcome to this, the 9th episode of Season 4 of the Dark Money Files, in which we shine a light into a murky world. I'm Ray Blake, and with me is my co-host, friend and business partner, Graham Barrow. Hello, Graham.
Hello, Ray.
Now, the last few weeks have been rather challenging for us all as we try to find new ways of doing our jobs, or in some cases try to find new jobs or replace lost income.
And at the same time, we are all spending rather more time in our own homes than we might choose to.
Or indeed than our families might like, Graham.
Well, that's also true, Ray.
The coronavirus dominates the news, the internet, most conversations we have on a day-to-day basis as well. So to an extent, it's the last thing I want to talk about on the podcast.
You know, Ray, I do feel the same way, but there are some very pressing impacts on the anti-financial crime effort that we really ought to talk about.
Yes, so with a deep sigh, let's dive in. Where shall we start?
Well, I think we should start with a reflection that you shared with me last week, Ray.
Oh?
About BCPs.
Oh, yes. Well, I simply thought that it was interesting that most business continuity plans, we used to call them disaster recovery plans, that I've seen, and all banks have one, centre on risks that deprive them of their premises, their IT systems or their people. I don't think many of them will have foreseen the implications of a lockdown.
And all over the country there are disaster recovery sites lying empty. And these would have been the cornerstone of the BCP in most cases.
And it's not the sites or the systems that have been lost, nor the people for the most part, fortunately, but rather being able to have people in the sites operating the systems.
Indeed. Now, most sizable organisations or newer ones will have been used to people working remotely, but we know many smaller, older firms where there are no VPNs and the place ran on fixed desktop computers and paper files.
And even in the largest and newest of banks, they won't have been geared up for most or all of the staff working from home.
That is very true.
You know, I always think of those huge dealing floors full of traders spreading their attention across half a dozen screens each, with multiple data services and trading platforms, and I just wonder how that can possibly be replicated for remote access.
I mean, it obviously can be, but that really won't have been the case on lockdown day one, I'm guessing.
And then the risks of market abuse means there are all sorts of rules for the trading floor that just cannot be enforced at a distance.
And what sort of rules are you thinking of, Ray?
Well, not having a smartphone, for instance.
Yeah, that's not going to be an easy rule to maintain at a distance across hundreds of private home back bedrooms, is it?
It really isn't.
Let's go back to the point about paper files, though. Most banks will have digitised their KYC files, so they are easily viewable by different departments that need to access them. The front office, compliance, transaction monitoring, and so on.
Yes, but many banks will still just have their KYC files on a shelf in a cardboard file. And if the people who need KYC information can't get to access those files, there are going to be issues.
For instance, how do you determine whether a flagged transaction in a new account is of a sort anticipated when the account was opened if you can't see the records created when that account was opened?
That's a good question, Graham. Here's another. If a client is due for periodic review and you want to refresh your KYC records, how do you do that without access to the details you already hold?
In that situation, wouldn't you just have to treat this the way you would a new client and start again from scratch?
Well, that would seem a sensible way to proceed until you start to consider the implications. It's a huge job to do this for hundreds or thousands of clients who might themselves have difficulties in obtaining documents or getting to the post office even. And since they're already banking with you, and may have been for some time, they might not see a good reason to engage in what is going to be rather more than a minor refresh of data.
And as well as that, I can't imagine making sense out of a review of account activity at the periodic review without a base of KYC information to judge it.
Me neither. But the banks provide vital services to the public. The branches need to be open. In the UK they are, albeit often on a reduced hours basis. So there are people who could access the records if need be.
Yes, but running a bank branch on a skeleton staff of key workers doesn't really leave time to take on additional duties, and I don't think it's realistic to expect that.
So I imagine there are banks that are placing their review programs on hold until the lockdown is over.
That sounds like a risky strategy to me, Ray.
Yes, given that many banks we know had review backlogs before the coronavirus hit, that's now just getting worse daily.
So, Ray, what's the answer?
Well, I don't know. But one approach might be to undertake a kind of best endeavours review based on what can be done in the circumstances, then record the aspects of the review that could be completed and those that couldn't, and diarise to complete the job when the restrictions are lifted.
Yeah, that limits the risk in a couple of respects, both the risk of regulatory censure and the more serious risk of financial criminals taking advantage while all eyes are off the ball.
OK, so that's records. Systems are going to be an issue too, aren't they?
They are, Ray. If we think about the systems typically used in a bank in onboarding and due diligence operations, many of them are proprietary or subscription-based and may well not be able to be widely deployed to personal homes.
So, given that you can't use a system that you can't access, what does this mean?
Well, it means either that you don't onboard...
And there are important societal reasons why that mustn't happen.
Indeed, Ray, or that you use publicly available data and tools instead.
Fortunately, these have come on considerably in recent years, haven't they?
Well, yes, they have, but there may be situations where they just won't take you as far as you need to go for complex EDD, for instance.
So what then?
Well, there's nothing in law or regulation that prevents a bank taking on a client subject to business restrictions, and that would be a good application of the risk-based approach.
So, we haven't been able to fully complete our due diligence on you owing to the current situation, but we know that you need certain facilities urgently. So, if we think we can do so safely, we'll extend those to you, pending satisfactory completion of the due diligence, but will restrict your ability in the meantime to do anything more extensive in the account.
Yes, but I think you'd want to put a timescale on that. You can't maintain such an interim arrangement forever.
Fair point, Graham.
I suppose the banks that will have most difficulty here are those whose processes are most rigidly engineered and dependent on proprietary systems.
Yes, you could make a case that in future there will be a value in having more flexible procedures that can use alternative means of discovery and assurance.
Yes, because the opposite of flexible is fragile, and banks need to be anti-fragile in future.
Looking at the new landscape as a whole, Graham, I think there's a more fundamental issue for banks to consider, though.
Are you thinking about risk appetite, Ray?
Yes, I am.
And it is a good point. Banks need to think about how fit their current risk appetite is for the new conditions, and they need to think about this carefully and quickly.
And determine what controls they need to adjust or introduce to reflect the changed risk environment.
Yeah, that's an angle I haven't really seen banks talking about, at least not yet. The focus has been on operational adjustments aimed at getting them as close as possible to business as usual, given the constraints. But maybe they need to zoom out and look at the bigger picture. There's no point checking the locks on the front door if the back door, frankly, has fallen off its hinges and the glasses come out of all the windows.
Well, no, I suppose not. But are we clear on what all of these changed risks and threats are, Graham?
Well, Ray, there is no shortage of analysis on that. All sorts of bodies, regulators, advocacy groups, consultancies, have issued general analysis, but it really is a matter for individual banks to determine through a proper risk analysis how these affect the particular bank's customers, products, and business lines, channels, and so forth.
Very true. I see most recently we have guidance from FATF.
Yes, we do. Shall we just briefly outline the key points of that, Ray?
The key findings are listed at the front of the paper, but there's a lot to be gained from reading the whole thing. Let's draw from both sources for this.
I think the larger part of the report is about the nature of the emerging threats, and that's less interesting to me than the later part of the paper that looks at the advocated policy responses.
I agree, Graham. Let's go straight there. FATF set out a range of actions that jurisdictions are in some cases already taking and in others could consider in response to the new challenges of emerging threats and constrained capacity. There's what you would expect in terms of supporting electronic and digital payment options and supporting electronic ID methods.
And most organisations will already have taken steps, I think, in this regard.
Quite so. And the paper refers readers to recent FATF guidance on digital ID that highlights that non-face-to-face onboarding and transactions conducted using trustworthy digital ID are not necessarily high risk and can be standard or even lower risk.
Yes, and that's an important clarification given what the regulations have said in the past about non-face-to-face business and relationships requiring elements of EDD.
Yes, there's also guidance here that supervisors, FIUs and law enforcement should coordinate private sector resilience and monitor and communicate the changing risk landscape.
And there's a suggestion those bodies should proactively engage with firms both inside and outside financial services to minimise potential impact.
Indeed, one aspect of this is giving regulated entities a contact point for when they face serious difficulties in meeting regulatory requirements and requiring them to keep relevant records and develop a plan to clear the backlog as the situation improves.
And that speaks to the issue we highlighted on periodic reviews. I see they advocate proactive engagement with the non-profit organisations sector.
Yes, and the concern here is that legitimate MPO activity isn't necessarily delayed, disrupted or discouraged. And that's going to include a whole bunch of newly formed MPOs trying to help in the pandemic response. So clearly we don't want their efforts unduly hampered.
Good point. There are some wider points on the risk-based approach and due diligence, aren't there?
Yes, FATF advocates what it calls full use of the risk-based approach and gives some examples.
Ooh, such as?
An interesting one is the use of simplified due diligence where lower risks are identified, and it singles out accounts specifically to facilitate government assistance payments or to allow access to digital and contactless payment solutions.
Now, in different times, I'm not sure I'd have considered those necessarily low risk.
Well, I think this exemplifies the line between rigour and pragmatism the industry has to tread here, given the new landscape. There's more. Firms might be allowed to accept recently expired government-issued ID to verify identity, or to accept digital copies rather than originals of documents on an interim basis, with originals to be cited in due course.
And I see they talk about proceeding with business restrictions where there may be delayed verification that will come later.
Yes. Finally, in this section, there's a suggestion that customers asked to provide documents to refresh KYC might face challenges and that the usual procedure for dealing with these updates not coming in might need to be reviewed.
The suggestion is very much that a firm shouldn't be closing accounts when the customer might not be able to comply with information requests due to illness or quarantine. They'll frankly have enough trouble as it is.
So that's due diligence. There's a section on supervisors undertaking pragmatic, risk-based supervision.
And they give some very interesting examples too. I like the one about focusing less on cash-intensive businesses that are currently closed.
Well, yes. Although if I were the relationship manager for a closed business whose takings hadn't actually dipped, I might want to find out why.
Yeah, that would be a bit of a giveaway from the takeaway, wouldn't it? And what an opportunity to spot cash money laundering businesses easily.
FATF suggests that other areas should perhaps be prioritised, such as online gambling, now that casinos and betting shops aren't available.
Well, there's a whole theme as well on authorities understanding and monitoring the evolving risk environment and communicating this to the private sector.
Yes, which should prompt firms to go back to their own risk analyses and risk appetites to fine-tune them appropriately.
All in all, then, this is useful guidance, isn't it?
It is, and to a large extent it mirrors what many regulators are already doing. There are some points in here that aren't yet in place widely, though. And because things are moving and changing so quickly, banks really need to stay abreast of regulatory guidance on a daily basis right now.
And I think that's a good closing point.
Now, last time, Graham, we said we'd give an update on the Dark Money Files conference, which we've been planning for later in the year.
Yes, Ray, and excited we are. So we've made the decision to turn it into a virtual conference when we'd originally planned to be gathering in person in the autumn, and to follow up with an in-person conference in the spring.
A virtual conference is going to be a bit different, isn't it?
Yes, it is. And a couple of months ago, I wouldn't have known where to start, frankly. But in the last few weeks, we've done a lot of work with Zoom and Teams and Google Hangouts. And actually, I'm very confident we can do something really worthwhile.
Yes, me too. We won't get everyone online for a full day, though, which we've found is very hard work for most people. Instead, we'll have discrete sessions over 2 days with keynote speakers and panels, and we'll find a way to add a networking element too, despite the constraints of being online.
Yeah, and we can also run activities in parallel that would have been quite difficult at a physical venue.
So watch this space for more information as it emerges. In the meantime, Graham, what's next on the podcast?
Well, Ray, how do you feel about we do an introduction to trade-based money laundering?
Oh, I'm looking forward to it.